What's up, y'all? It's your boy Ty, and in this video, I'm going to be teaching y'all how to fish. In this video, we're going to be going over a stock screener, how to find exactly what you're looking for. Stay tuned. After this one, you might not even need me anymore. Let's get into it. Welcome to Piece of the Pie with Ty. I'm Ty, and I appreciate y'all coming to check my channel out. If you like any of the content in this video, please hit that like button and subscribe to the channel. My channel is all about making sure people are aware of the different avenues out here to get a piece of the pie. With that being said, today we're going to talk about stock screeners. What is a stock screener? A stock screener is a tool that you can use to find exactly what you're looking for. You can find small cap companies, large cap companies, dividend companies, all of that. But I'm going to show you guys on the computer exactly what I'm talking about. Let's go to the computer. Alright guys, so we're on Dividend Watch. If you don't know what Dividend Watch is, I suggest you check out one of my videos because it's definitely a helpful site and tool. Alright, but today we're going to be looking for a dividend company. So I'm going to use the screener on Dividend Watch. So I'm going to go straight to screener. And the reason I'm looking for a dividend company because I want to be very bullish on dividends. And I was noticing in my portfolio that I don't have many high yield dividend companies. So we're going to fix that by making sure we go ahead and find some high yield dividend companies. So first we're going to go to dividend yield, and this is what a stock screener is all about, finding that perfect company. So we're going to go to a yield of about 7%. I'm going to take this up to like 20. Of course we probably don't find anything 20, but just to give us that range. Dividend growth, I'm not going to mess with that right now. Payment frequency, doesn't matter right now, about monthly, quarterly, or yearly. Type, I want to REIT. Alright, I want to REIT. Market cap. Market caps are very important for picking those companies with higher growth or more stable companies. If you don't know much about market cap, please check out the video I did on market cap. Exchange. I'm in the United States, so I'm going to pick the New York exchanges here in the United States. But no matter where you at, you can check wherever you at on Dividend Watch. Then volatility. I want very stable. That's very important to me when it comes to dividends. So very stable. And then simply hit search. And now it's going to pull up all the companies that fit the criteria that I have chosen. So, and it's sorted by market cap. So the ones at the top are the larger companies. So they should be a little more stable, bigger names. So, and it's good to point out that right here, when you see this NA, this is supposed to be the payout ratio. When you see this NA, a lot of companies, due to COVID, suspended their dividends. So I definitely don't want any of these companies that had this NA. So you see one of the more popular companies, I see a lot of people talk about it all the time, MFA Financial. It has an NA because they had suspended their dividends sometime this year or last year. That's not a strong company, if you ask me. A strong company is going to keep giving you your dividends no matter what's going on in the market. And that's the type of company that you want to be relying on dividends. So these companies that still have that percentage, they didn't falter. Alright, so there's a lot of nice names up here. I know this is one that's real popular, AGNC. But I'm going to click on this. I'm going to show you guys what it looks like when you actually click on a company on Dividend Watch. Alright, so you have the dividend yield. It'll tell you what it pays out annually. It'll tell you the payout ratio, which is how much percent of its earnings it actually pays out. stock volatility, PE ratio, price to earning ratio, cash payout ratio. But what's really important for me when we're talking about dividend companies, you slide down the frequency. All right, so you see in 2018, AGNC, they had a dividend of, it's a monthly paying dividend if you guys don't know. They had a dividend of 18 cents. All right, kept that up. And then all of a sudden it faltered in 2019 and it went down to 16 cents. And in 2020, it went to 12 cents. And then this year, it had a point where it suspended dividends. And then it jumped back up to 12. So, yeah, it's a company that kept paying its dividends during the pandemic. But to me, that doesn't show stability. And you come down, it will show you guys its fundamentals. Its net income. Net income in 2019 was positive, and then it went negative in 2020. Of course, a lot of companies went negative 2020, so I wouldn't hold that against too many companies. Cash flow, you see the cash flow is positive, and then its total liabilities went down. So that's pretty good. It went down in 2020, and then it showed you its chart. All right, its actual chart. Then it even gives you some similar companies right here. So, and one other thing that is important, it tells you which ETFs hold that stock, which is really important because these are big investors. These are big investors that own a good chunk of it, you know? So it's good to know who owns this company in ETFs. So that is AGNC, but I didn't go with them. So we're going to go back. All right. And again, I was just looking at a whole bunch of different names. And as I came down, you actually can see over here a little quick brief summary of the company as we go down. But one that stuck out to me was this Omega Healthcare. Omega Healthcare with a dividend yield of 7.09%. So I took a look at them. I clicked on them because it made common sense. Healthcare REIT. I'm like, okay, that sounds pretty good. It shows you what they pay out annually. $2.68. That sounded great to me. Cash payout ratio, stock volatility, company debt level is a little high, but it's okay for me. But what I really liked about it was its consistency with its dividends. So in 2018, it was 66. All right, cool. 66. Oh, it jumped to 67. And they kept it at 67. 67. It isn't an increase, but it's consistency. They increased it by 1 cent and they stayed consistent even during the pandemic. That's big for me. And they stayed consistent for the last, 1, 2, 3, 4 years. They have stayed consistent and went up in dividends. So to me, that's a strong company when it comes to me relying on dividends. And net income, it was positive. And again, in 2020, a lot of people got hit, so it went down. But they had a positive net income the years before. Cash flow, it was negative in 2018, 2019, 2020 positive. And liabilities, it went down and got a little bit more debt and liabilities, but not much, 0.02% in 2020. And then its chart looks good to me. The growth looks great. And then you see the ETF exposure though. As you see, this one doesn't have as many people on it as AGNC did, but I like Omega, HOI. I like them. So I added Omega Healthcare to my portfolio. I have REITs already. I have one REIT already in my Robinhood portfolio, and I have another REIT in my long-term investing portfolio. But Omega Healthcare, I like them. I added them to my portfolio in both. Kind of give me a little diversity too, not just the typical REIT, the REIT that is primarily in skilled nursing and assisted living facilities. See it right there. All right. So that was one company that I added using this screener. We're going to go back one more time. All right. Now we're going to get a little more in depth. Dividend growth. So the companies I showed you thus far, they haven't had that increase in dividends. One has stayed the same and one had a drop down and then come back up. So we're going to go dividend growth. We're going to put 1%. That means it's got a steady dividend growth. I'm going to put 1%. And then let's search that first. It chopped some companies off. It chopped a lot of companies off. Same thing, but it's just dividend growth. All I did was add dividend growth. And it chopped a lot of those companies off because they haven't been increasing their dividends. So I got two companies here. And you guys know I went with one of them. All right, so when we click on ACRE, okay, all right, you see annually pays $1.32, and it's definitely a good price, $16.92. And one of the reasons it is this price because it's a small cap company. The other companies were big companies. This is a small cap company, meaning that it has growth. It should do some pretty decent growth. And then we come down to the dividends. And in 2018, it was 28 cents. You're doing 2019, 33 cents. You're doing 2020, 33. So you see a big jump in growth from here to here. And it increased their dividends. So, but again, this is a company that's it's smaller cap. So as you guys know, the newer a company, the less money it seems to be a little more risky than some of those large cap companies. And you see the growth it has. It dropped during COVID. Yeah, it's COVID right there. And then it jumped back, and that's something that's important too. It had quick recovery. Market capitalization, as I said, it's small cap. So on the other ones too, you could have looked right here and saw the cap. But it's a small cap company. All right. And I like what I saw. I like what I saw a lot. Small cap company that's steadily growing, and it was able to handle COVID like it won't nothing. It didn't stop its dividends. At all. And it's a small cap company. All right. And I guess we can check on what the competition was. The competition was XNA. I'm not familiar with this company, but we're going to check them out. Bam. This is why I didn't go with this company. Based on missed expected dividend payments, we detected that dividend payouts might have been suspended. So they was giving out 82 cents, and they dropped heavy in 2020. So I didn't go with this company. That's exactly why I didn't go with this company. So I added ACRES to my portfolio. But you guys can see on Dividend Watch, you get to see exactly what's going on. So yeah, I didn't add this company. Now I'm on my portfolio. You guys have seen this too if you looked at my dividend portfolio. And this is why I said I'm about to go hard on dividends, because I'm into a lot of companies, and a lot of companies were tech companies, but I didn't have many companies at all that had high dividend yields. So that's why my dividend yield is only 1.97 for my whole portfolio. Of course, it's taking into account companies that don't give dividends, like AMD and like Corsair Gaming, and like a CRISPR. But I want that number to be a lot higher than that. So as you guys see, I added ACRE, just 2 shares. Again, I'm not a rich man. Just slowly add to my positions. So I'm gonna start adding to ACRE, and I'm gonna start adding to Omega, which is right here. I got 2 shares of them too. So I'm gonna have to start adding to those positions because they have a nice yield. They have a very nice yield. And those companies are going to help me add to my portfolio. You guys know I don't add companies rarely, but I just showed you guys how to find exactly what you're looking for. If you want to find large cap companies, small cap companies, mid cap companies, like I said, make sure you check out that market capitalization video. But you can find whatever you need and compare it. Alright. Alright guys, I hope that was very helpful. That was a basic rundown on how to use a screener. We look for dividend companies, but you can use a screener to find whatever company you want to find. You can go into different sectors with your screener, but that was just the basics on how to use one. So you can go fish for your own companies now. Of course, the screener is just going to give you the financials and the basics, and then you can do your own research on them after you look them up on the screener, but they'll be on your radar. So you can find the best companies that fit exactly what you are looking for. Alright, if you like any of the content in this video, please hit that like button and subscribe to the channel. And come back and see me. I got plenty more to talk about. Thanks.